This is the most important and ambitious budget in decades.
We're not going down the path of changing the negative gearing arrangements, abolishing negative gearing or abolishing the capital gains tax discount.
It's a responsible budget and it's a reforming budget.
Right now, is negative gearing, are you going to touch it or not before the next election? Is it changing?
No, we have no plans to change negative gearing.
Categorically, negative gearing is off the table.
Yeah, it's off the table.
This is probably the best budget I have seen in a long time. Now I know that sounds strange because if you are a property investor, the first reaction to this budget might be fear. Negative gearing is changing. Capital gain tax is changing. Discretionary trusts are being targeted. The way investors use tax losses, structures, and long-term growth strategies is being questioned. This is going to be the biggest generational wealth transformation that people will ever have access to.
Will you guarantee that you won't touch negative gearing and capital gains tax concessions?
Well, we have no plans to touch or change negative gearing.
This is a pretty cynical budget as well, but it's one that you can hand down maybe.
Jim Chalmers is billing it the answer to generational pressures.
At a time of very serious global uncertainty and adversity, it's all about aspiration and opportunity.
This is the moment where this government falls over.
This is the best budget because the budget distinguishes winners versus losers very clearly this time round. Not having the right structures or buying the wrong investment not only pushes your ROI backwards, but the government penalizes you for being stupid as well. Hi. My name is Rajan Sharma, COO of Investor Partner Group and Director of Cashflow Real Estate. I work closely in the property investment and real estate space, helping clients build long-term wealth through strategic property decisions. Over the years, I've spent a lot of time analyzing market trends, policy direction, lending environments, and how government decisions flow through to investors and everyday Australians. In fact, many of the changes announced in the Tuesday 12th May 2026 federal budget were things we have been discussing and preparing our clients for well in advance. Not because of insider information, but because understanding how policy and market cycles work allows you to anticipate where things are heading. As a result, many of our clients were already positioned and prepared before the announcements were officially made. So, what we'll cover today? In our conversation, we will cover the exact changes that are rolled out for property investors and homeowners. Things like changes to negative gearing and capital gain tax. When do they start? Who do they apply to? What is being grandfathered and what property type to focus on? Is it established versus brand new? And the answer will surprise you. More importantly, how can you still claim negative gearing even when it's not allowed post-2027? Trust versus company distributions. Is trust investing dead? First home buyers versus investors. We'll also cover how will the market react to these changes. Will the established property prices fall? Which markets would change? Which markets will grow? Where should the investors focus now? What should people focus on? And lastly, we'll be answering questions like PPOR versus property investing, how to fix your current property portfolios, and what are the key next steps. Stick to the very end and we have a surprise for you. A complete blueprint of these changes and an invite to a secret invite-only budget night conversation for only those who stick to the very end, which will unlock everything you need. So, let's go. Now, let me be clear. This is the first time the government is telling investors exactly where they want capital to go. And when the government shows you the direction of policy, smart investors do not just complain, they reposition. This budget is not really about killing property investing. It is about changing the type of property investing the government wants to reward. If you buy an existing property and compete with the first home buyers, the government wants to reduce your tax advantage. So, before everyone panics and says property investing is dead, we need to understand what the budget is actually trying to do. Now, let's talk about negative gearing first, because this is where most of the confusion is. A lot of people are saying negative gearing is gone. That is not really accurate. Negative gearing is not completely gone. It's only deferred. And let me explain how you can still claim the losses. What is changing is where you can use the loss. Traditionally, if you bought an investment property and the rental income did not cover the interest, holding costs and deductions, you could use that loss to reduce your personal taxable income. So, if you are a high-income PAYG earner, negative gearing helps soften the cash flow pain. That was a reason many investors were comfortable buying properties that were negatively geared. They were not necessarily making money from day one, but the tax refund helped them hold that asset long enough to benefit from capital growth. Under the new rules, for established residential properties, that immediate benefit changes. Losses from established residential investment properties purchased after the budget announcement will no longer be deductible against the broader personal income from 1st July 2027. Instead, those losses are quarantined, meaning they can generally be used against net positive rental income or future residential property growth gains. Established residential properties acquired between budget night and 30th June 2027 can still use current arrangements until 30th June 2027. But from 1st July 2027, those losses become subject to the new rules. For example, let's say you buy an investment property of 500k and the property brings in about 30,000 a year in rent. But your total expenses, including interest repayments, insurance rates, maintenance, and the management fees, comes to around 50,000 a year. That means you're running the property at a $20,000 loss annually. Under the previous negative gearing rules, that $20,000 loss can be deducted from your salary income. So, if you earn 120k per year from your job, the government taxes you as if you only earn 100k. So, here is what the budget has changed from July 2027. If you buy an established property after the new rules begin, you may no longer be able to deduct those losses against your salary income. So, if you still make a $20,000 loss on the property, now your taxable salary stays at the full 120k. You don't get that immediate tax benefit anymore. Instead, the loss gets carried forward and can only be used later against future rental profits or capital gains. Let's presume you sell the property now in 3 years for 800k and made a 300k in net profit. You can claim $60,000 in losses and pay taxes only on 240k. So, the loss is not gone forever, but the short-term cash flow pressure becomes much higher. Now, here's the catch. When negative gearing is allowed for another year for properties purchased after the budget night up to July 2027, the new bills are also protected from these changes, and traditional negative gearing benefits are available in full. So, under the same example, if 500k was a brand new property you bought, that property can claim a loss of $20,000. In fact, also depreciation expenses of an extra $15,000, reducing your taxable income from 120k to $85,000. So moving forward, many investors may start looking more closely at new developments, build-to-rent properties, co-living properties, and high cash flow investments. Because under the proposed rules, cash flow becomes much more important than simply rely on tax reductions. So for investors, the question changes. Previously, the question was that how much tax can I get back? Now, the question becomes, can this property actually take care of itself? That is a huge behavioral shift. And this is a behavior shift I've been advocating for years. Negative gearing was never a strategy. It was a scam. Running property losses in hope one day the property may perform without having a proper strategy in place is the biggest scam the Australian Taxation Office has been advocating, which finally comes to an end. Because if a property only worked because of a tax refund, then maybe it was never a strong investment in the first place. This budget is going to expose investors who are buying poor cash flow assets and relying on tax refunds to survive. It is going to expose investors who did not understand their true holding costs. Investors who buy purely for future capital growth without considering income, debt, vacancies, maintenance, land tax, and risk. But at the same time, it will reward investors who understand cash flow, supply, structure, and strategy. So when people ask, how can you invest when there's no tax break? My answer is simple. You invest the way serious investors should have always invested. You invest based on fundamentals. You look at rental demand, you look at cash flow, you look at household income in the area, you look at vacancy rates, you look at infrastructure, you look at employment, you look at the supply pipeline, you look at whether the property can be improved, and you look at whether there is rental pressures so that the property can turn into net positive in year 3 of your investment journey. That is the difference between passive speculation and strategic investing. Now let's move into capital gain tax, because this is a part of the budget that I think could have been even bigger long-term impact than negative gearing. The government is replacing the current 53 capital gain tax discount with an inflation-based, cost-based indexation model from 1st July 2027. And it is also introducing a 30% minimum tax on capital gains under Discretionary Plus. Also, the CGT discount remains intact for brand new builds. In fact, investors constructing new housing can choose between the current CGT discount of 50% and the new treatment. Now, let's explain this in simple terms. Under the old system, if you held an investment property for more than 12 months, you could generally discount the capital gains by 50%. That was extremely powerful. It meant property investors could use leverage, hold for long term, and then receive concessional tax treatment on the profit. The new system is trying to make tax apply more to the real gain after inflation, but it also reduces the generosity of the old 50% discount in many cases. So, what happens when the tax outcome on selling becomes less attractive? Investors focus more on brand new properties and compete against first home buyers. They also sell less, they hold longer. They become more selective with choosing cash flow over growth. They become more careful before selling and rebuying outside super. They may stop recycling property portfolios as aggressively. And this is where the policy could create an unintended consequence. The government may think this will free up established homes for the first home buyers. But if existing investors decide not to sell because the CGT outcome is worse, supply of the established homes for sale could actually tighten in some markets. In fact, as newer properties grow more in value, the established properties will follow the pursuit. That is why I do not think the market reaction will be simple. What we are more likely to see is a more segmented property market. Affordable property markets will see established properties rising more, as new investors would still play in these locations and use their super to buy in these locations. The existing investors in these locations won't sell, which means owner-occupier will have more competition against less stock available, thus pushing upward pressure on price. Also, in more expensive metro markets, the established properties may actually stagnate, as investors would step out of these areas due to no benefits. An owner-occupier and the first home buyers won't want to play in these locations, thus pushing the rental up even further. We cannot base first home buyers versus investors debate when we are talking about budget and property. Politically, this budget is clearly positioned as helping first home buyers. The government wants to say we are reducing the unfair advantage investors have when they compete with the first home buyers for the same established properties. That is the political message. And to be fair, there's logic behind it. If investors are getting tax advantages to buy existing homes and first home buyers are trying to buy those same homes with after-tax income, the government sees that as an unfair advantage. So they're trying to tilt the playing field. ABC reported that the government expects those reforms to help move around 75,000 homes from investors to owner-occupiers over 10 years. But here is the critical analysis. Helping first home buyers by reducing investor demand is only one side of the equation. The bigger issue in Australia is supply. If we do not build enough homes, then shifting demand from investors to first home buyers does not magically solve affordability. Also, all 5% deposit schemes and government grants are not available for established properties. They are there for brand new properties where investors would now play. Do you really think investors with deep pockets will not overpower first home buyers and push them out of the market? It just changes who is bidding. And that is why the housing supply and productivity part of the budget is actually one of the most important pieces. The government is funding last mile infrastructure to unlock up to 65,000 homes, including faster approvals, land preparation, and modernizing the National Construction Code. So, post-budget, the question for investor becomes, Am I buying something that already exists, or am I helping create something the market needs? I'm going to answer this question at the very end of this conversation. Now, let's talk about discretionary trusts. This is another area where the government is clearly targeting wealth structures. The budget introduces a 30% minimum tax on discretionary trusts from 1st July 2028. Furthermore, the distribution in the discretionary trusts are done via non-refundable tax credits only for non-corporate beneficiaries. What that means is when income is distributed to individuals via trust, the minimum tax they pay is 30%, even though their personal tax might be lower. Also, if you had bucket companies within discretionary trusts, there's no tax credits available to them at all. Let that sink in. That means the bucket companies pay taxes twice. Once at discretionary trust level, and secondly, whatever is distributed to them is also taxed again at the corporate rate of 30%. This is a significant change from the long-standing approach where trust income is generally taxed in the hands of beneficiaries at their own marginal rates. Now, does this mean trusts are dead? And shall investors buy properties in personal name or company structures? No. And I would be very careful with that language because it's slightly more complicated than that. Trusts are not only used for tax, they are also used for managing borrowing capacity, asset protection, estate planning, business structuring, succession, and family wealth management. And let's not forget that brand new bill CGT discount and negative gearing is still available to trusts versus company structures. But the tax flexibility of trusts is being reduced. That means investors with discretionary trusts need to review their structures because the wrong move can create CGT issues, stamp duty issues, land tax issues, and borrowing issues, and asset protection issues. Let's look at an example. A lot of investors in Australia use discretionary trusts to buy property and distribute income and capital gains across family members. In fact, a lot of businesses and sole traders also use discretionary trusts for tax planning to allocate income to people earning no income like their wives or parents or adult kids. But the new federal budget changes could completely change how these structures work moving forward. Before the budget changes, let's say a family trust earns 300K in total profit from investments and property income. Instead of all that income being taxed in one person's name, the trust can distribute the income across multiple beneficiaries in the family. They distribute the 300K income. 80,000 goes to the wife, 70,000 goes to the husband, $50,000 goes to another child at a university, and another 100K might go into a family company or another beneficiary. Because the income is spread out, each person pays tax at lower marginal tax rates. That is one of the biggest advantages of discretionary trusts in Australia. Now, let's compare that to the post-budget system. From July 2028, the government is proposing a minimum 30% on discretionary trust income. So even if the trust distributes income to beneficiaries or lower tax brackets, the trust structure itself may still face a minimum 30% tax floor. The worst news, the family company where 100K is allocated to have to pay tax twice. One at 30% while the trustee of the discretionary withholding, and then again 30% when the income is disclosed by this company, essentially being penalized for asset protection. So, what should be the path going forward? For brand new properties, unit trusts to be used with 100% ownership to the bucket company to safeguard capital gain tax and better allocation of assets and income. For established properties, use company structure to protect the borrowing or buy it under an SMSF. Also, only focus on development potential properties for established properties so that even though you may not get CGT discounts, you have profits to play with and GST credits. Ultimately, manufactured returns become even more important than just pure buy and hold strategies. Let's not forget SMSF. This is where things get super interesting. Remember that super is a low tax environment. The budget appears to target individuals, trusts, and partnerships more directly, while superannuation was not hit in the same way across these property tax changes. Superannuation and small business concessions were largely untouched compared to the broader changes to CGT, negative gearing, and trusts. The taxes in super is capped at 15%, and a 33% CGT discount means effective tax rate drops to 10%. So naturally, people will start asking, does this make SMSF property more attractive? Well, yes, and for everyone. And SMSF is not a loophole. It is not a shortcut, it's a retirement structure. You'll need to consider contribution limits, borrowing rules, liquidity, diversification, compliance, and whether the investment fits the retirement purpose of the fund. But relatively speaking, if the tax environment outside super becomes less attractive for certain investors, SMSF property may become more interesting. The strategy with super is not about long-term hold. It's not about negative gearing. It's about short to medium-term growth and exit as holding costs in super is considerably higher. So, exit strategy in super. Considering there's no brand new builds in super unless you pay a premium via one-part contracts, it's more about catching the growth faster and selling and reducing the debt as fast as possible. Now let's talk about one very practical question, one that has had every cheeky investor scratching their heads after the budget. What if I turn my PPOR into an investment property? This is going to be a big one. The budget says existing arrangements remains unchanged for properties held before budget night. But the technical treatment of a principal place of residence that later becomes an investment property needs careful advice. So, the safe answer is the purchase date becomes irrelevant here and the date of change of purpose becomes relevant. And thus, it triggers a valuation and CGT and negative gearing does not apply even though the purchase of this may be even prior to the budget date. Because owning the property before budget night and using the property as an investment before budget night may not always be treated the same way. So, I will not tell people to assume grandfathering automatically applies to every PPOR conversion to investment property situation. Now, let's bring all of this together and ask the most important question. Who is most exposed after this budget? The most exposed investors are high-income PAYG investors who are relying on negative gearing refunds to make the numbers work. They are the people who bought expensive established properties with weak cash flow and no development potential, expecting the tax system to help carry the loss and expecting that owner-occupier emotions will keep driving up the prices. The next most exposed are investors with low yield assets and high debt. Because if interest costs stay elevated and the property cannot cover itself, the investor has less tax relief to soften the pain. The next group is investors using discretionary trusts mainly for tax distribution outcomes. If the trust was mainly there to split income and reduce tax, that strategy may need to be reviewed. But there are investors who are relying heavily on selling and recycling capital gains. Let's answer the most important question. As an investor, am I buying something that already exists or am I helping create something the market needs? The established properties with development potential now become even more important as you lose CGT and negative gearing on them. So an exit strategy needs to be clearly defined. The best properties would be where you can split and sell the front and keep the back, add granny at the back, subdivide land or small-scale subdivisions. All of these would be either in a company structure to protect borrowing. The buy and hold for short to medium term growth is something that fits SMSF best because your CGT is protected there. The strategy is to buy and sell and reno. The strategy is to buy and sell and reno flips works best there. The brand new properties with high yields like co-living, duplexes, dual income, or house with a granny fits the best in personal portfolios to get negative gearing benefits and also in unit trust structures for better tax management. They shouldn't be purchased under the company. Also, company structures are cheaper than trusts, so of course use them for established properties with clear exit strategies. Lastly, identify lands in high growth corridors because they will be the first to go. And look, if you still have questions after watching this video, that's completely understandable. Because this budget is one of the biggest shifts we have ever seen in property investing, tax strategy, and wealth creation in a very, very long time. That's exactly why we are hosting a live webinar where we are going to go much deeper into this conversation. We break down the budget in more detail, talk about the implications for property investors, first home buyers, trusts, SMSFs, and long-term wealth creation. And most importantly, we'll answer your questions live. So if you're wondering how these changes could impact your current property portfolio, whether you should restructure, what strategies may work better moving forward, or what the next best steps look like in this new environment, this webinar is something you do not want to miss. Join us for what is going to be a very engaging and very important conversation around the future of property investing in Australia after this budget. The registration link is in the description below and we look forward to seeing you there. And if you're looking for budget cheat sheet with all changes and what decisions to make drop us an email at admin@investorpartner.com.au or drop strategy in the comments below for my team to put you in touch with me to help you fix your property portfolio. Till then, take care, keep smiling, keep investing. This is Rajan Sharma checking out.